To Daniel DiMartino Booth, the former Dallas Fed advisor who was warning us about this actually years ago before anyone else was paying much attention. Danielle, it's coming to fruition right now. I always am amazed when you think in terms of a country, all we have, all our land, all our assets, all the things that make America great are dwarfed by the things that make America not so great, what we owe. And it's not even close. What do you think?
No, you're talking about apples and oranges here, and to the point of we overstimulated the U.S. economy, and now we're paying the price. We're paying the price in spades, and Americans are living paycheck to paycheck, even making good sums of money right now, in what is still a tight labor market. But the idea, Neil, the notion that raising taxes when you're headed into a recession is somehow going to help anything, all it's going to do is create higher joblessness in this country, which is the last thing that we need at this juncture. So no, we absolutely have to get this debt under control. The Federal Reserve has a role to play. I'm sure that they're being really pressured by the administration to not raise interest rates too much because, God forbid, we don't have the money to service this pile of debt that we've got.
Yeah, and if you think about it, even if they go slow on rate increases, it appears that's not the case. And people have strong views either way on this. I'm not here to debate that. But they're starting something today, this sort of great unwinding of all these assets they've gained and money on the books totaling almost $9 trillion, and relinquishing that could compound the problem right now, right?
It certainly could. You're seeing corporations in America have trouble, whether it's a small business or a large business. You're seeing corporations have trouble accessing finance at these levels. And now we're going to be pulling liquidity further out of the market at such a fragile time. You have to wonder if you're going to see a continued increase, which we're already seeing, by the way, in companies that are going bankrupt and in companies that are defaulting. These are real world problems, and they involve real world people who are at risk of losing their jobs the worse this gets.
So with this quantitative tightening versus quantitative easing, and they start getting rid of mortgage securities and treasury notes and bonds, all that floods the market. Now, obviously not at once, and it takes a while. What do you play that out for me?
Well, you're obviously going to have buyers of the new debt that's going to be issued by the Treasury. But I would dare say that public pensions, life insurance companies, some of these entities are absolutely begging for, they're dying for higher yielding debt so that they don't have to play the Federal Reserve's other game, which is taking on too much risk in the junk bond market or in the stock market that's inappropriate for the retirees who are relying on them being very good fiduciaries.
So what does the Federal Reserve do? I get a feeling that they're going to continue hiking rates and try to maintain this or try to crack inflation a little bit. I don't know if it succeeds. But now in combination with, unloading all of these Treasury securities, it's the only game in town. It's the only one doing something, whether you like the Fed or not. We're not seeing it out of anyone else in Washington. So what happens?
We're going to wait and see, Neil. I think that there's a very orchestrated reason that the Federal Reserve is not planning on having quantitative tightening ramp up fully until after Labor. They might be looking to pause on rate hikes. They want to see how this is going to affect America. They don't want to crash the plane, so to speak.
Got it. Well put, Danielle. Thank you very much. Danielle DiMartino Booth.